Good morning. Welcome to your solo 401k webinar. Hopefully you can hear me okay now. We're having some volume issues there. Well, thank you for joining today's daily webinar Q&A session with my solo 401k financials, where we help you to stop overpaying taxes and start building real retirement wealth. As always, this is your chance to get answers. Use the chat to ask questions regarding today's topic, which is how does solo 401k work for S-Corp, or any other topics surrounding solo 401ks and even self-directed IRAs. And we'll pause and answer those questions as they come in. Looks like we've got a question here already. Looks like an operational question. I emailed correction to the 1099R my solo 401k sent last Friday. When should it come back to me? Allow about 5 business days. This is the busiest time of the year, but as long as you submitted the request, we'll make sure to follow up with that corrected form 1099R. Okay, let's continue here. Give me a moment here while I get to my slides. Okay, so let's go over the first slide here. So before we start talking about today's topic, let's make sure we have all our slides in order here. Okay, here we go. We're having a little bit of a streaming delay here, so give me a moment while I try to fix it here. So before we delve into how does a solo 401k work for an S-Corp, let's talk about the eligibility requirements for a solo 401k plan. So in order to open a solo 401k plan, you have to be self-employed. So if you operate your business as an S corporation, a solo 401k can be one of the most powerful and tax-efficient retirement strategies available. An S corporation can certainly sponsor a solo 401k, and the S Corp structure offers unique planning advantages when paired with the solo 401k, especially when you compare it to other self-employed businesses, such as a sole proprietorship or a partnership. So let's break down how it works and why it can be so effective. So what is a solo 401k? Also known as a one-participant 401k, owner-only 401k, uni-K, or solo K. So it's simply a traditional 401k plan that covers business owners or owners and their spouses, as long as the business does not employ any non-owner full-time W-2 employees. In other words, it's no different. In other words, it's not a different type of 401k. It follows the same IRS rules as any other 401k plan. The key difference, however, is that it covers only business owners and their spouses. Let's take a look at the next slide here. Looks like we might have another question here. Here we go. Let's take a look at this question and then we'll pick back up where we left off. I'm in Florida. I have an active LLC, but expect little or no revenue. Can you keep the solo 401k active even if you don't plan on making another contribution for the current year? Good question. And we've actually covered this very topic in prior webinar sessions. Let me see if I can dig up a post on that topic here. Give me a moment here. Actually, we have a few posts on our website with webinars regarding this particular topic. Give me a moment while I dig it up here. So while I'm digging that up, you can continue with the solo 401k plan as you are not required to make yearly contributions. Of course, in order to contribute to a solo 401k plan, you have to have earned income from self-employment activity. So if you don't have any earned income from self-employment activity in a particular year, then you will not be able to contribute. So what is more, you are not required to make annual contributions to a solo 401k plan, even if you do have earned income from self-employment activity. I'm going to send over a link regarding when you can close a solo 401k. Now, there may be a year in which you don't perform any material services, aka self-employment activity. That doesn't mean that you don't qualify for the solo 401k or that you still can't continue with the plan. So in some years, you may be more active than other years from a self-employment activity. The rule is that once you close your self-employed business, then you have to close the plan down. And that makes sense because obviously you can't have a 401k without a business. It's not like an IRA, which is an individual retirement arrangement, where you don't have to be self-employed or have a business to open an IRA. Well, 401k plans are sponsored by a business, whether we're talking about a self-employed solo 401k plan for a solo business owner versus a full-time employer 401k for a traditional business like a full-time employer plan. Let's say you work for Microsoft or NVIDIA and you separate from service from NVIDIA. Just because you stop working from NVIDIA doesn't mean that that 401k closes. Well, contrast that with a solo 401k plan that's sponsored by your self-employed business. Once you close your self-employed business, you cannot have a solo 401k plan because you have to have a business tied to that 401k in order to continue to sponsor a 401k. So if NVIDIA decided to close its doors or it went out of business, then the NVIDIA 401k plan would no longer be operational because NVIDIA Corporation would have closed its doors down. So when you leave your full-time employer plan, the business doesn't close, so that plan continues. But again, with the solo 401k plan, your business has to be active in order to continue with that solo 401k plan. Take a look at the post I just shared with you. I'm also going to share one other one here with you. Give me a moment while I dig that up here. This one is titled Freeze My Solo 401k Plan. So take a look at that other post there that I just shared a link to. Now, looks like we're having a few connection issues this morning, unfortunately. Hopefully you got that link right there. Give me a moment here. Okay, so let's continue to try to work with our connection here. Hopefully you guys can hear me here. see here. Hmm. Give me a moment, please. Okay, again, thank you for your patience there here with our connection issues here. But take a look at the link I just shared with you regarding freezing a solo 401k as part of your good question there. Now, we're going to take a look at some more questions here in a moment, but before we get to those questions, let's continue with our webinar for now, or try to, because again, we're having some connectivity issues here. So let's talk about how a solo 401k works for an S-Corp. When your business is taxed as an S-Corporation, the S-Corp sponsors the solo 401k plan. Also, all of the owners who receive W-2 wages from the S-Corp can participate in the solo 401k plan. Let's see here. Hopefully you can hear me okay right now. Give me a moment here. While I try to bring my slides back up here. Bear with me here. Thanks for your patience again. Okay, let's take a look at some questions here while our slides upload again here. So here's a question here. I have been self-employed as a sole proprietorship for many years, and my spouse has had a separate W-2 job. She retired in 2024. Starting in 2025, she has helped me and my sole prop, but has not taken any income as a paycheck. Our incomes are mixed in a joint checking account, and we file taxes as married filing jointly. Can we file separate Schedule Cs in the business as qualified joint venture? So if you have a sole proprietorship, then typically you would convert that to an LLC tax as a sole proprietorship. So that means your self-employed entity type would be an LLC, but it would be taxed as a sole proprietorship. Therefore, if you both work under that same LLC, you would each file a separate Schedule C, and therefore you could each contribute to that same solo 401k plan based on your respective Schedule Cs. As a result, each spouse would be able to maximize their annual solo 401k contributions up to the overall limit for the year. So for example, for tax year 2025, the overall contribution limit is $70,000. It increased to $72,000 for 2026. So if you wanted to contribute for 2025, you could each contribute a separate amount of $70,000, providing you each have enough Schedule C, line 31, earned income from self-employment activity to support the contribution. So the bottom line is that both spouses can participate in the same solo 401k plan As an example, if the LLC is taxed as a sole proprietorship and you both work under that same LLC, you would each file a separate Schedule C. Okay, let's keep going here. I think we've got our slides back. So let's pick back up where we left off. So again, we're talking about how an S corporation works that sponsors a solo 401k plan. So with an S corp, the contributions are going to be based strictly on W-2 wages paid by that S corp. So if both owners or both spouses are working under the same S corporation, then each would receive a separate W-2 and they could contribute to the solo 401k plan based on their respective W-2s that they receive from that S-Corp self-employed business. So unlike sole proprietors or partnerships, contributions are not calculated from Schedule C or Schedule K1 income. Instead, they are calculated from Box 1 of the W-2 wages generated under that S corporation self-employed business. Now let's talk about if both spouses work in the same S corporation. So if both spouses work in the same S corporation, then it's going to be one S corp. So both spouses are owners and employees in that same S corporation, or one spouse can be the owner and the other one doesn't have to be an owner, but he or she would need to work in that business. And they each receive W-2 wages from the business. So as a result, they can both participate in the same solo 401k plan. So there's one plan sponsored by the S corporation. It's not separate plans for each spouse or each owner. It's one plan because the solo 401k plan is sponsored by the business. It's not sponsored by each spouse. It's sponsored by the S corporation. As a result, each spouse can make employee contributions, catch-up contributions if eligible, meaning they're age 50 or older. They can also make employer profit-sharing contributions. They can also make voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. So this effectively doubles the household contribution potential. Okay, let's keep going here. Now let's talk about multiple owners in an S corporation. So if an S corp has multiple owners, then as long as each owner receives W-2 wages and there are no full-time non-owner W-2 employees who are age 21 or older, then all owners can participate in that solo 401k plan sponsored by the S corporation business. So it's important to be cautious that there are other solo 401k providers out there that tell each owner to open up a separate solo 401k plan. And that structure is not correct. It's incorrect, as a matter of fact. Why? Because the solo 401k plan must be sponsored by the business entity itself. So opening separate plans for each owner can trigger IRS reporting confusion, complicate Form 5500 easy filings once assets of the plan exceed 250,000 in market value, and often results in unnecessary duplicate setup and maintenance fees. So bottom line is one business equals one solo 401k plan. Instead, each participant has separate holding accounts under that solo 401k plan to track their contributions. Here's an example. Let's say that there are two owners in that S corporation. Well, the S corporation sponsors the solo 401k plan, so it's just one solo 401k plan, but each participant is required to have separate holding accounts under that solo 401k plan. So as the slide here illustrates, it would be a total of 6 holding accounts, aka bank or brokerage accounts, under the one solo 401k plan that's sponsored by that S corporation to hold the various fund sources, that is pre-tax, Roth, and voluntary after-tax solo 401k funds for each participant. And that's because a solo 401k is a defined contribution plan, and as a result, the Internal Revenue Code requires separate holding accounts for each participant and each source of funds to track their various contribution sources. So again, it's not 2 separate solo 401k plans. It's one plan that's sponsored by that self-employed S corporation that has separate holding accounts for each participant and for each source of funds. So that's an example of a 2 participant plan. Now let's talk about, and then here's an example of a 1 participant plan. Obviously, if there's only 1 employee in that S corporation, so just 1 owner, then it would just be, it's still just 1 plan, but you would have 3 separate bank or brokerage accounts, aka holding accounts, to hold your respective fund sources. 1 pre-tax, 1 Roth, and 1 voluntary after-tax. And that voluntary after-tax bucket is used as part of the Mega Backdoor Roth Solo 401k strategy. And here at my Solo 401k Financial, we do offer a Solo 401k plan that allows for the Mega Backdoor Roth strategy. That is, it allows for voluntary after-tax contributions, as well as end-plan conversions, where you can convert the voluntary after-tax Solo 401k funds to the Roth Solo 401k, or you can even convert them to the Roth IRA instead. We're not going to get too much into this because today's webinar deals more with S Corporation sponsoring a solo 401k, not so much with the Mega Backdoor Roth Solo 401k strategy, even though it is a very popular strategy for our clients. But this slide here will give you some more information regarding whether you should convert your voluntary after-tax solo 401k contributions to the Roth Solo 401k or to the Roth IRA. I can tell you that most clients seem to convert to the Roth Solo 401k instead, because just like Roth IRAs, Roth Solo 401k plans are no longer subject to required minimum distributions, which apply once the account holder reaches age 73. It used to be that it applied, but no longer. So required minimum distributions no longer apply to Roth Solo 401k plans, just like Roth IRAs are also now subject to those required minimum distributions. Okay, let's get back to our slides here. So why an S-Corp and solo 401k is often more advantageous. Let's talk about that. So again, today's topic is, how does the solo 401k work for an S-Corp? Go ahead and type over your questions. It can be regarding any aspect about solo 401k plans and self-directed IRAs, and we'll get to them here shortly. So for sole proprietors and partnerships, so again, we're talking about why an S-Corp and a solo 401k is more advantageous. So 1, contributions are not going to be impacted by self-employment tax. So when your self-employed business is an S corporation versus a partnership or a sole proprietorship business, those contributions to the solo 401k plan will not be impacted by your self-employment income tax. Excuse me, your self-employment tax. So for sole proprietors and partnerships, employer contributions are calculated after reducing income for self-employment tax. So this effectively reduces contribution capacity. Whereas for an S corporation, the contributions are going to be based solely on W-2 wages. So there's no self-employment tax adjustment that applies to an S corporation when you are, that's your self-employed business, and you take W-2 wages. So the calculation is, so the solo 401k contribution calculation is simpler, and it's often more favorable because it takes less earned income from self-employment activity to maximize your annual solo 401k contributions when as compared to a sole proprietorship or partnership self-employed business. Now, employer contributions are not subject to FICA. Let me bring up some slides on that. Again, we're having some streaming difficulties today. Thanks for your patience here. Let me see if I can bring up my slides again. So where are my slides here? Okay, hopefully you can see that. So again, thanks for your patience here during these outages with our streaming system. We generally don't have these type of hiccups, and we go live on a daily basis. In the meantime, before I get to my next slide here, let's take a look at some questions here. Here's a question. Is LLC tax as sole proprietorship the only way to have spouse participate in the solo 401k? How could I keep the sole proprietor structure and still have spouse participate? Well, so if you're self-employed and as a sole proprietorship, that means that you're receiving a 1099 NEC because you're doing contracting work. Now, if your spouse is also doing contracting work and she receives her own separate 1099 NEC, then she can open up her own separate solo 401k plan. So you would each have two separate solo 401k plans. But if you both want to participate in that same solo 401k plan, you both have to be working under that same business. So as a result, you could convert it to an LLC tax as a sole proprietorship, and then you would have those 1099 NECs issued in the name of the LLC. And then if you both work under that LLC, then you would both file a separate Schedule C, and that would result in just one solo 401k plan, because the solo 401k plan would be sponsored by that one entity, that is the self-employed LLC business. Okay, here's another question here. I'm a sole proprietor over 50 and I have enough earnings to hit the solo 401k maximum for the year. I've historically made 100% after-tax voluntary contributions. How should I allocate new contributions across pre-tax Roth and after-tax buckets? And does the catch-up contribution need to be placed in a separate bucket? Good question. So the great thing about a solo 401k plan is that you can decide the type of contributions that you want to make each year, whether you want to make solely voluntary after-tax solo 401k contributions, or if you want to make some employee pre-tax, some Roth, some employer pre-tax, some voluntary after-tax. In other words, you can mix your contribution types. The key is not to go over the overall contribution limit, and also making sure you understand the calculations. So for example, when you calculate contributions to a solo 401k plan for a self-employed business tax as a sole proprietorship, the starting figure for that calculation is going to be line 31 of that Schedule C, which is the net self-employment income line. You then plug that figure onto our solo 401k contribution calculator, which will reduce that line 31 by 1/2 of self-employment income tax. Once that's performed, then you can make employee contributions, which are a dollar for dollar calculation. And for tax year 2026, that employee contribution limit is $23,500. And then for the employer profit sharing contribution, that's going to be a percentage calculation. It's going to be 20% of that figure there after you subtract 1/2 of self-employment income tax from that line 31 figure. And then once you add those two amounts together, you can choose to make the difference up to the overall limit as a voluntary after-tax solo 401k contribution. So in short, you can choose the types of contributions you want to make each year. You can contribute some of each or all as voluntary after-tax solo 401k contributions if you choose to. Regarding the catch-up contribution, since your business is taxed as a sole proprietorship, as long as you're age 50 or older, then you can make catch-up contributions. And if you're age 60, 61, 62, or 63, in 2026, you can even make a super catch-up contribution instead of the normal catch-up contribution. And you can choose to make those to the pre-tax solo 401k or to the Roth solo 401k holding account. It's important to note that neither catch-up contributions nor super catch-up contributions can be applied to the voluntary after-tax solo 401k bucket. They can only be applied to the pre-tax solo 401k bucket or the Roth solo 401k bucket if we're talking about a sole proprietorship. Now, we're going to talk about an S corporation here in a moment regarding how catch-up contributions are impacted for an S corporation, especially with the new Secure Act 2.0 regulations calling for mandatory catch-up contributions to be applied to the Roth solo 401k holding account and can no longer be applied to the pre-tax solo 401k holding account if your business is taxed as an S-Corp or C-Corp. And it also depends on your earned income threshold. So, good question. Okay, let's get back to our slides here and continue with today's presentation, which is how does solo 401k work for an S corporation? So let's get back to that specific slide here. So we've been talking about contributions. We just discussed employee contributions regarding an S corporation. Now let's talk about employer contributions, how they work for an S corporation self-employed business. Well, one, when an S corp makes employer, aka profit sharing contributions, they are going to be deductible on the S corporation side, not on the personal side. So the S corporation deducts that employer profit sharing contribution on the Form 1120S corporation tax return, reducing the corporate tax amount for the year. Also, employer profit sharing contributions are not subject to Social Security or Medicare, aka FICA. Again, that applies to sole proprietorships and partnerships. Also, they're not subject to FUTA. So this creates payroll tax efficiency, not available in the same way for sole proprietorships or partnerships that sponsor a solo 401k plan. So that's one of the advantageous ways that an S corporation is, or that's one of the ways that S corporation is more advantageous over a sole proprietorship or a partnership self-employed business. It has to do with employer contributions. And as I mentioned earlier, it typically takes less W-2 wages to maximize contributions when your self-employed business is taxed as an S corporation versus a partnership or sole proprietorship. Because with the partnership, contributions to the solo 401k plan are based on your Schedule K1 self-employment income figure. And for a sole proprietorship, it's going to be based on line 31 of your Schedule C. And you have to subtract 1/2 of self-employment income tax in order to maximize your contributions. Well, that subtraction of that 1/2 of self-employment income tax doesn't apply to S corporations when you're making employee or employer profit sharing contributions. So from a planning perspective, with an S corp, you can control your W-2 salary level. You can also control the percentage of employer contributions, which is up to 25% of your W-2 wages. So this allows strategic tax and retirement optimization. Now, before we talk about the contribution types for an S Corp solo 401k plan, that is S Corporation that sponsors a solo 401k plan. Let's see if we have any other questions. Looks like I don't see any other questions for the moment. So let's continue with our slides here. Now, we would really appreciate it if you took a moment to like and subscribe to our YouTube channel and like us across the various social platforms, as this will really help us to spread the word out to other solopreneurs so that they can more easily find this great educational content that we deliver on a daily basis and many times twice a day. As a matter of fact, we'll be going live again here in a couple hours. So please help spread the word by subscribing to our YouTube channel and sharing our information across the various social platforms. We would really appreciate it. So let's talk about contribution types for an S-Corp that sponsors a solo 401k. So each W-2 owner in that S corporation can make all contribution types. They can make employee contributions up to the annual elective deferral limit for the year. They can also make catch-up contributions if age 50 or older, or the special age 60 through 63 super catch-up contribution when applicable. They can also make employer contributions up to 25% of their respective W-2 wages from that S-Corp. And of course, they can make voluntary after-tax solo 401k contributions, therefore enabling the mega backdoor Roth solo 401k strategy. Now, it's important to understand that in order to make contributions to a solo 401k plan for a business taxed as an S corporation, the contributions must be based on actual W-2 wages paid to each owner in the business. Distributions or K-1 income do not count. If you pay yourself zero W-2 wages, then you cannot make solo 401k contributions. And also, each participant's contributions are calculated separately based on their respective, that is, their own W-2 wages. Now let's talk about opening a solo 401k for prior year contributions. Let me pull up my slide for that one here. Give me a moment. So if your self-employed business is taxed as an S corporation, then it's not too late to open a solo 401k plan in the current year so that you can make prior year solo 401k contributions. So if you establish a solo 401k plan here in the current year, so tax year 2026, by the business tax return deadline, including extension, you're going to be able to make prior year, that is year 2025 solo 401k contributions. So you'll be able to make year 2025 solo 401k contributions, which means you're going to be able to make employer profit sharing contributions as well as voluntary after-tax solo 401k contributions. However, you will not be able to make employee contributions if that solo 401k plan is opened in the current year for the prior year. Because in order to make prior year solo 401k employee contributions, the plan had to be adopted by December 31st of the prior year. But however, if you open that solo 401k plan that's sponsored by your self-employed S corporation by March 15, or if you file for a business tax return extension by September 15, then you're going to be able to make both employer profit sharing contributions and voluntary after-tax solo 401k contributions for tax year 2025, just not employee contributions. So that's some good information to be aware of for those who are still trying to make contributions to a solo 401k for tax year 2025, where their self-employed business is taxed as an S corporation. They have not yet opened the solo 401k plan, but they want to try to maximize contributions for tax year 2025 because they did have W-2 wages from their self-employed S corporation. Okay, let's continue with our slides here. Now let's talk about Form 5500 easy reporting considerations. So any solo 401k plan, whether sponsored by a S corporation, sole proprietorship, or partnership, is going to be subject to annual Form 5500 easy information return filing, which applies when total plan assets exceed 250,000. So here at my solo 401k financial, we provide Form 5500 easy preparation and filing assistance for clients who timely request that Form 5500 easy filing. So if you need a Form 5500 easy prepared, make sure you timely request that, and you can go to the Forms tab of our website for more information on how to communicate to us to let us know you need a Form 5500 easy prepared for your solo 401k plan. So let's share some final thoughts here. I don't see any other questions at the moment. So again, we're talking about how does a solo 401k work for an S corporation self-employed business. So a solo 401k paired with an S corp is one of the most powerful retirement structures available to self-employed business owners. Why? Because it allows for example, high contribution limits, payroll tax efficiency, spousal participation, multi-owner flexibility, where they can all participate in the same solo 401k plan. Of course, the Mega Bacto Roth Solo 401k strategy. It also allows for solo 401k participant loans, where each participant can borrow 50% of their respective solo 401k balance, not to exceed $50,000. And also it allows for the $1,500 auto contribution credit, where effectively the government is subsidizing both the cost to open and to maintain a solo 401k plan for years to come by opening a solo 401k plan that has the auto contribution credit built into it for a total of $1,500, which is spread out over a 3-year period in $500 increments. And you file Form 8881 each year to claim that credit, and you file that with your business tax return. So when structured properly, one S Corp equals one solo 401k with multiple participating W-2 owners. So if you operate an S Corp and want to maximize retirement contributions efficiently, a properly designed solo 401k can be a cornerstone for your long-term strategy. Okay, again, we'll be back here again with more questions here in a little bit. We'll be live again in a couple hours. Let's see, it looks like we have one more question here. Let's take a look at that. Now, if this information is helping you feel more comfortable about your retirement future, please take just one moment to like and subscribe. It tells the platform that you find this information valuable, and it'll help others to find it more easily. So subscribe to our YouTube channel, like us across the social platforms. That would really be beneficial to us so that we can continue to educate the public regarding self-directed IRAs and solo 401k plans. Let's take a look at this question here. So, spouse participation. We made a 2025 Roth IRA contribution to a separate account, not in the solo 401k, for my wife, thinking we should work in the business. But she does not get 1099s, has no earned income, only Social Security and pension. Will we need to withdraw the Roth IRA contributions? Good question, and the answer is no. So one, a solo 401k plan is different than an IRA. So a solo 401k is an employer-sponsored retirement plan. It's a qualified retirement plan, whereas an IRA stands for individual retirement arrangement. Oftentimes you'll hear it called an individual retirement account, but if you look at the IRS code, it's technically an individual retirement arrangement. But nonetheless, the contribution rules that apply to 401k plans, including solo 401k plans, do not impact your IRA contributions. Instead, if you made a contribution to your IRA, as long as you had earned income, which you appear to have had if you're a contractor, then you qualify to make that IRA contribution. What is more, there's also what's called a spousal IRA, where the spouse who doesn't have any earned income can piggyback off of the earned income of the spouse that does have earned income for making IRA contributions to his or her own separate IRA. Hence why it's called a spousal IRA. So you can actually open up a spousal IRA for your spouse, in this case, your wife, using your language here, and then you can use your 1099 NEC income to contribute to her IRA, whether it's a traditional IRA or Roth IRA. Now, depending on your earned income amount for the year, you may not qualify to make Roth IRA contributions if your modified adjusted gross income is too high. However, you could still make a contribution, whether a traditional IRA contribution or what's called a non-deductible IRA contribution. But not to get too deep in the weeds here, yes, you can make contributions for your spouse, in this case your wife, even if she did not have any 1099 NEC income, because the spouse can piggyback off of, the non-working spouse can piggyback off of the working spouse's earned income for making contributions. Let me see if I can dig up a spousal IRA page from our website. Here we go. I've got something here. And you can even, it even references the IRS code section where you can learn more about spousal IRAs. Take a look at that link I just shared with you there. Okay. Let's see here. Here's another question here. Looks like we've got some questions coming in here at the tail end of the live webinar. That's great. Again, we'll be live again here in a couple hours. So if you don't get a chance to type over your questions, come back here in a couple hours and we'll be live again on the air. We typically go live at least once a day, many times twice a day. Sometimes we don't go live at all. It just depends how busy we are and the time of the year. Even though it's a very busy time of year, we try to make sure we go live this time of year because of the tax filing season. So here's a question from John. Already subscribed. That's great. Thanks for subscribing to our YouTube channel. For those that haven't subscribed yet, please subscribe so that you receive notifications regarding when we go live, so that you get a chance to be notified about the crucial content that we deliver every day to help you secure your retirement future. So follow-up question. So far for 2025, the max voluntary after-tax contribution I can make is $70,000. That's exactly right. For tax year 2025, the maximum voluntary after-tax solo 401k contribution is $70,000, regardless if you're age 50 or older or younger, because you can never apply catch-up contributions to the voluntary after-tax solo 401k bucket. Okay, let's see here. On the contribution form, then does the catch-up need to be made as either pre-tax elected deferral or profit sharing? Good question. So catch-up contributions are actually always considered employee contributions, never employer contributions. Keep in mind that employer contributions are a percentage calculation. It's 25% of your W-2 wages if you're self-employed business is taxed as an S corporation or C corporation. It's 20% of your net self-employment income after you subtract 1/2 of self-employment income tax if your self-employed business is a sole proprietorship or a partnership. So the employee contributions are always calculated on a dollar for dollar basis. It's not a percentage because it's not an employer contribution. Employer contributions are always percentage based, not dollar for dollar based with respect to the calculation. Now, excuse me, let's see. Need a little water. Um, Let me see if I covered another topic here regarding today's topic, which is how does solo 401k work for an S corporation? Give me a moment here. Um, Now, it looks like I didn't go over this part here. Let's talk about mandatory Roth catch-up contributions starting January 1st of 2026. This is actually a very important regulation, and we've actually performed a webinar on this topic in the past. That is the mandatory Roth catch-up contributions. See if I can pull up that slide here. If not, I'm just going to have to wing it here. Well, here we go. I think this is the one I'm looking for. So, mandatory Roth catch-up contributions starting January 1st of 2026. And this is going to be very important for those who self-employed businesses, an S corporation or C corporation. Partnerships and sole proprietorship self-employed businesses are not subject to this new regulation regarding making Roth catch-up contributions, Roth solo 401k contributions, that means. So let me see if I can pull up some information here as well on that from our website, because again, we've covered this in the past in a separate webinar, so I'm going to share that link here on the live chat as well once I get to it. Okay, let me share this link here, and then I'm also going to go over it as well. So take a look at the link that I just shared here on the live chat regarding mandatory Roth catch-up contributions starting January 1st of 2026. It's important to understand that these mandatory Roth catch-up contributions do not impact tax year 2025 contributions. It only impacts tax year 2026 solo 401k contributions. So beginning January 1st of 2026, if a participant's prior year W-2 wages from the S-Corp exceeded the IRS threshold, which is $150,000, then any catch-up contributions must be made as Roth solo 401k contributions. Therefore, you cannot apply them as pre-tax solo 401k contributions. And again, this applies solely to S corporations and C corporations that sponsor a solo 401k plan. And these same rules apply to full-time employer 401k plans. So if you work for the Amazon Corporation and you participate in the Amazon Corporation 401k, then if you make any catch-up contributions because you're age 50 or older, for example, they're going to have to be applied to the Roth 401k holding account. You can no longer make them into the pre-tax into the pre-tax 401k account. Same concept with the solo 401k plan. You can no longer make catch-up contributions or super catch-up contributions to the solo 401k pre-tax bucket. They have to go to the Roth solo 401k bucket if your W-2 wages from that S-Corp exceed the threshold, which is $150,000 for the prior year. Now, let me try to dig something up here. Give me a moment here. One moment here. Now, you're going to want to look at the Social Security wages of that W-2. I'm trying to remember what line number that is. Give me a moment here. So you're going to want to look at box 3 of your form W-2. So if that box 3 of that W-2 has $150,000, or excuse me, if it exceeds $150,000, then you're going to have to apply the catch-up contribution as a Roth solo 401k contribution. You won't be able to apply it as a pre-tax solo 401k contribution. So take a look at that link I just shared with you. So the key point here is that if an S-Corp owner or C-Corp owner earns above the threshold, then their catch-up contributions cannot be pre-tax. They must be Roth contributions. So you're going to want to make sure that you coordinate your proper payroll amount with your payroll company and your CPA. Okay, again, take a look at that link I just shared with you because we actually hosted a webinar on this particular topic. Well, I think we've come to the end of our session here. So that's it for today's solo 401k session. Again, we'll be live again here in a couple hours. Thank you so much for investing your time with this. Your time is valuable, but we feel that your future depends on it. So if you haven't yet, please like and subscribe so that we can keep building this community. That'll really help us out. Until later, you have a good rest of the day.